I know when down payment is less than 20%, there is a PMI. So would you explain this PMI?
Sure.
How does it work?
Yeah, let's talk about that. The PMI. The PMI, basically, when you put less than 20% down there with a conventional loan, not VA loans. I don't want to get too specific, but conventional, when you put less than 20%, you have PMI. Now, I've heard so many times, well, my loan doesn't have PMI. Well, there are two types of PMIs. Either the borrower pays the PMI, or it's called a lender paid MI, which is embedded into the interest rate. So the borrower always pays PMI if they put less than 20% down. So, but we do have programs which we call an 80-10-10 or so on and so forth. So what we do is we give you two loans, right? One loan and a second home equity line of credit, so you could avoid the PMI, right?
Nice.
So that's another way of avoiding PMI. And also the PMI factor, the PMI cost, or the private mortgage insurance cost, it really depends as to how much you're putting down. Is it 5%, 10%, or 15% down? And it really depends on what is your credit score, because if you have a very high credit score, the PMI factor, the cost, is much less than somebody having a bad credit score, right? And it also depends what is your debt to income ratio, what your income to your liability ratio is. If you have a lesser ratio, then you have a better factor. So it's not a specific amount, $200 or $300 or $400. It all depends on the loan amount, on your credit score, on your down payment, and your debt to income ratio. And we do have a lot of borrowers that they do take that route, getting a PMI, than not getting it. So it's not a scary thing. It's a good thing. We can talk about it, and once a borrower comes in, we'll sit down and go with all the options that they have, and they will truly understand what it's all about.
Amazing.